everybody. Welcome online and welcome to our speakers today. I'm going to hand over to Alex at this stage. Thanks, everyone.
Okay, thanks, Carolyn. Good morning, good afternoon, and good evening, wherever you might be. Today, we are coming in from New York City, Montreal in Canada, Johannesburg in South Africa, and Lausanne in Switzerland. It's a great pleasure to host you. I'm Alex Hetherington. I'm a perennial student of ESG and mostly an advocate of all things ESG and sustainability. Today, we're tackling a thorny issue of whether the sustainability sector has driven itself into a compliance corner with excessive reporting requirements, frameworks, and scoring systems. We have the GRI, we have the ISSB, we have CDP, SASB, TCFD, just to name a few of these sustainability-related frameworks and reporting guidances. It sounds like the proverbial alphabet soup. It is confusing to the layperson, and I think in many ways it is also confusing to executives and board members of companies as well. So how do companies untangle all of this? How do they ensure that they don't get stuck in reporting for reporting's sake? How do they actually steer themselves to implementing and practicing sustainable strategies that actually at the end of the day allow us to function within the economic, social, and environmental constraints of our planet? So we have a fabulous panel today to help us address all of these issues. First up, we have Jennifer Motlers from Lausanne in Switzerland. She is the Chief Sustainability Officer of Philip Morris International and arguably at the coalface of sustainability reporting. She is widely recognized for leveraging sustainability within Philip Morris and allowing a deep focus in sustainability to drive their business strategy and agenda going forward. Jennifer holds a Master of Laws in International Law and Human Rights from University of California, Berkeley, and she also has a Doctor of Law from the Universidad de Chile. Michael Ree in Johannesburg, South Africa, is well known in many countries for his sustainability and consulting offerings and services. Michael is the managing partner of IRAS, which stands for Integrated Reporting and Assurance Services. It's a boutique consulting offering in ESG reporting and insurance. And not only is Michael involved in many nonprofit initiatives within the South African landscape, but he's also the author of a 200+ annual report that comes out, a critique on ESG reporting and effectively looks at the efficacy of ESG reports that are coming out from various companies in South Africa and other places. And then from Montreal in Canada, we have MJ Privic, Chief Innovations Officer at ESG software development company Novesto. Novesto is all about ESG data and the data that fills sustainability reports, sustainability strategies, and sustainability decisions from corporates. She's a former financial analyst, a director of investor relations, an ESG advisor to companies and to investors alike. In addition to a BCom in finance from McGill University, MJ is, among others, a CFA charter holder and holds the fundamentals of sustainability accounting from the Sustainability Accounting Standards Board. So I think we have a wonderful panel here. I'm so very much looking forward to the discussion, and I'm very much looking forward to inputs and questions that will come from the audience. Just to give you a heads up, we will start discussion among the panelists to stimulate thoughts, and then we will give at least 20 minutes at the end of the webinar to take questions from the audience, and you can direct those either as a viewpoint of your own, or you can direct questions to the panelists themselves. We will facilitate that. So I want to dive straight into it. Jennifer, as Chief Sustainability Officer within a very large multinational corporate organization, let's start from the beginning. What are we trying to achieve through sustainability reporting?
Thank you. And thank you so much for having me in this panel. I will try to be brief and give you a meaningful answer. I think that the point of sustainability reporting, it's perhaps twofold, is to give clarity to external stakeholders about how a company defines and measures success. A sophisticated sustainability reporting integrates financial and non-financial or pre-financial performance, and internally to give clarity to your organization, to employees, about what are the priorities, what is the purpose of the company, and where are resources being allocated. I think these are the two main purposes of sustainability reporting we're trying to achieve. I'll stop there.
Okay, thank you for that. Michael, you started your career, I believe, as a sustainability advisor in one of the big four accounting firms. If we are to tackle some of the naysayers around sustainability, is sustainability reporting actually being driven purely from a financial opportunity needs from consultants and advisors? I'd like to hear your viewpoints on
that. Yes, far too much, in my opinion. I find that we continue to find all these new opportunities for consultants to sell services that are over and above what companies ought to be focusing on. And just in supporting Jennifer's comment there, it is about, the whole thing about informing stakeholders about, what your priorities are, what you're actually doing, giving clarity on how you're managing your success, both from a financial and non-financial performance, and of course, informing internally. Because for me, and that's been proven over and over and over again, that the real value of sustainability or ESG is not in the report that gets published and sent to stakeholders externally. It's what happens in the organization. And so there's a question that I believe you're going to raise about, and just this point, I think that Karen was made, or it might have been yourself, sorry, that are we backed into a corner? And is it a bit of a compliance corner? And the answer is only for those companies that haven't yet figured out what this is all about and how you benefit as an organization from understanding what reporting should be trying to achieve internally within the organization.
Okay, thank you for that. I would just like to come in with, before I move to MJ, just a personal bit of experience of working with some companies where in the past, and I'm not saying that this is necessarily the case at the moment or going forward, but sustainability departments have been set up within organizations, and they have, in essence, really got bogged down in just trying to gather the data and input information into a report, a standalone sustainability report, or some kind of questionnaire that is being asked by various kinds of stakeholders. That often limits their ability to look at this information strategically and guide and make decisions based on that. So MJ, I just want to move to you as a person who actually holds deals, manages with this non-financial data, ESG data. Is data the starting points that companies should be looking at when embarking on their sustainability journeys?
The short, very, very short answer to your question. Hello, by the way, and thank you for having me. I'm super happy to be here and looking forward to this conversation. Very, very short answer to your question is no, data is not the starting point. Before you can collect or produce data in a report, you need to understand what it is you want to be talking about in your report. You need to understand, the topics that you want to be covering, and the topics you want to be covering are the topics you need to be managing. And so then we get into the identification of material issues, whether you take a very narrow lens or a broad lens to materiality, single materiality, financial materiality, double materiality, impact materiality. Doesn't matter. It's about identifying the issues that are relevant to you that you need to manage, then identifying how are you going to measure performance? How are you going to know if you're doing a good job managing those issues? And once you know that, then you can identify the data you're going to need to collect in order to measure that performance. Once you have your data, then you can start using tools to collect that data and start worrying about data quality, performance measures, etc. Are they necessary? Absolutely. Do you need to measure what you're managing? Yes. It's not the only thing you need to do, but it does help. And to that extent, I think it's also important to contextualize reporting not as an end in itself, but as a means to an end. It's part of an accountability mechanism that is part of the overall management process of any management process, by the way, not just sustainability issues. So it's an important mechanism. It's an important activity. It's just not the only thing and the end goal. I'll stop there.
Yeah. Thank you very much. If any of the panelists have any thoughts, just do come in. But yeah, Michael, straight away. Thank you.
Am I allowed to disagree?
Yeah, of course.
Data is king. The problem that most companies have still is that reporting is based on storytelling, and storytelling can't occur in the absence of the data. Performance data is absolutely fundamental to everything we do. That doesn't necessarily mean that companies have to explain all data, but when analysts are looking at the reports, and companies are even looking at reports from a benchmarking and performance perspective, they can't do that without the data. And so even where a company doesn't feel something might be material, whether they're doing the double materiality assessments, whether they're doing impact materiality, whatever it is, there are stakeholders out there that look for specific data. And so in my experience with all the companies that I've ever worked with, data is king, and there's no such thing as too much data. What there is too much storytelling about data that isn't linked to the material issues. And so everything has to be linked back to materiality, of course, but the data has to be there simply for modeling purposes. You've got to be able to put the data out there and allow people to compare and contrast not only your own data from a time series perspective, but also from a peer perspective.
Can I just jump in for one clarification?
Absolutely.
The question was not whether data is important. I completely agree with you that data is very important.
Whether it's a starting point.
Whether it's the starting point. What data are you going to collect if you don't know what you're collecting data on? I completely agree with you. Data is very important. I think sometimes we give too much importance to data, and the quality or the specificity of the data is actually used as an excuse to not actually do anything. It's used as a legitimacy for procrastinating and not taking action on certain issues. So I think we have to relativize these concepts and these messages. So I think, it's just to clarify what the initial question was.
So I'd like to bring Jennifer in here.
And for me, the starting point is data. You can't start management of sustainability, let alone reporting, in the absence of the data to understand where you're at in terms of whether you're ahead of the curve, behind the curve, or whatever. You have to have the data there in order to be able to start even thinking about, okay, so what are the material issues and how are we performing against that?
Thank you. Okay. So Jennifer, I would imagine in your position, you've got some pretty challenging sustainability issues that you have to deal with. How did you go about it? To reference back to this discussion between MJ and Michael, how did you determine what data you needed? How did you put it together to address your stakeholder needs? And then very importantly, I would love to hear your viewpoints on how you have been able to take this ESG information and translated it into business strategy for the company.
Mm-hmm. So I have to say I agree with what MJ was saying, in that it's important to understand the order of things, what comes first and what you're trying to do and what you're trying to achieve. And the reason why I say this is because there is such a thing as information overload, and you can produce so much data and dump it out there in a way that you actually defeat the purpose of transparency, put out there so much data that is difficult to understand, difficult to process, difficult to assess, and difficult to connect to corporate strategy. And I think that if you think about externally, especially we're in a place where we're thinking about ESG or non-financial reporting and elevating the quality of this data in terms of robustness, in terms of rigor, in terms of reliability, in terms of comparability, so that it can be used for decision-making purposes by investors, by the financial community, by other stakeholders, then we need to be very, I say we, in my role, or sustainability practitioners, need to be very clear about what are you trying to achieve with the disclosures that you put out there. And so I think that if I think about where we started, where we were, before you get into a place where you understand what you want to measure, how you're going to define success, how you're going to measure progress, what governance is going to exist, even before that, you need to understand that the list of ESG issues is infinite, but not all ESG issues are created equal. It very much depends on the company you work for, what the product and services that you offer, and where is it that you can have a greater impact. And so I think that, and I say this, as you know, PMI is a tobacco company. I could put beautiful data out there and talk to you for hours about diversity inclusion or the decarbonization of my company. And don't get me wrong, these are very important things that we are doing. But this is not the most material issue. The most material issue is a cigarette company. The biggest externality that we create comes from the impact of the products that we sell. And therefore, the core of our strategy is making sure that we can transform our company, redefine success, and a corporate strategy that is based on not making or selling cigarettes anymore. And so that is the moment where you can say, well, if this is the core of my strategy, the core of my strategy is transforming my entire business model, my entire organization, my entire value chain. What am I going to do and how am I going to measure it and what information I'm going to put out there? And that's where data comes in, right? Because, and this is a true story. The first sustainability report that we put out there, when the transformation of our strategy was starting, there was a letter from our CEO that said something, I'm paraphrasing, in 2015. I envision a world where cigarettes don't exist anymore. And everybody was so excited in the company, wow, the CEO is talking about not making cigarettes. And the external stakeholders were like, you can say whatever you want, but show me how you're going to do it. And so indeed, that's the place where you need to decide what kind of metrics are you going to use. And it's a set of metrics that are financial and non-financial, that are measuring different things, that are tailored to your strategy, that are unique to your value proposition. And I think that's really the key of sustainability, as an opportunity for innovation and growth, not as a risk management, operational efficiency approach. What are you going to measure? What are you going to communicate? It's really what will set you apart, certainly within your industry, but also as a business. And so I think that if you start from data, you have an ocean of data points that don't really mean anything. And so even before getting there, you need to understand what is your value proposition? What is your strategy? Where do you want to get? And that's where, in a more selective way that is more coherent, you can ground what are those data points that are material to your strategy, that are meaningful, that are impactful, and that your external stakeholders, investors, or other stakeholders are going to be watching out for, to understand how are you planning not just for the short term, but how is it that you're building preparedness and resilience for the long term.
Okay, thank you.
So here's a problem with waiting for data. In South Africa a few years ago, we got to a point of near day zero in Cape Town, which meant that literally the city of Cape Town was about to have no water. And we had many companies that had determined, because the primary materiality determination system is the risk register, they had determined that water was not material. And so fewer than 20% of all JSE listed companies in South Africa were actually reporting the amount of water that they use. And nobody knew who to go to figure out what needed to be done in order to manage the crisis that was unfolding in Cape Town. And this was inclusive of companies that were headquartered in Cape Town, and includes companies that still to this day do not report on their water consumption. And so, so the data, you can't allow your own materiality, particularly if it's of a very narrow focus, internally focused, risk register variety. You can't focus on only collecting the data that you think is important, because oftentimes companies are very short on what that data is. And to speak to you more specifically, Jennifer, I had worked with British American Tobacco many years ago, over 20 years ago, in one of their first sustainability reports. And the question was raised, can a tobacco company be socially responsible? And it was really quite interesting because they put out a competition to university students to write an essay to take the position yay or nay. Can a tobacco company be socially responsible? And of course, the winning essay was a no. And British American Tobacco published that article, or published that thought leadership piece in their sustainability report. And yet British American Tobacco was far more socially responsible than about 99% of all Africa-based companies. And so there was a great dialogue that spun off of that around what is or is not, within the dialogue of sustainability or ESG in today's vernac. And so as I say, you don't know what your performance is unless you know what your data is. Data, there's no such thing as too much data. I'm fully aware of the concept of data obesity and the fact that we are collecting so much data in today's world, but it's data that drives everything. That which is not measured is not managed. That which is not managed cannot be improved and cannot be effective for a variety of stakeholders. And so data is always king. So in our world, we start, most of our clients, most of the companies that we work with, even ones that aren't our clients, but that respond to our annual research, we start with a data table of 239 to 259 indicators. And in most cases, companies will get above 90% in terms of that data, because that data is already available. They just haven't thought of that data in the context of either ESG or sustainability.
Okay, I want to come in here on a thought, and I'm going to bring MJ in on this one. And it's leading from you there, Michael. So we're talking about data being king, but data is historical. It's backward looking. It gives us information of the past. What about ESG actually needing to look into the future under scenarios, under futures unknown? We are talking about here, for example, climate change. I'm picking up on your point about water scarcity in different parts, and then these sudden shock events such as a day zero environment. How does ESG reporting, what is the best way for ESG reporting to be actually factoring in unknown futures that will help the resilience of a business and a company going forward? MJ, do you have viewpoints on that?
Sure. There is no doubt that when you're talking about ESG or sustainability related issues, there is much more of a forward-looking dimension. It's actually getting baked into the standards that are being produced to improve sustainability reporting. The way to do that is by mandating or requiring through standards information about future outcomes, whether that's scenario planning and analysis as recommended by the TCFD. By the way, you could do scenario planning and analysis on climate, but you could also do it on a bunch of other issues. It's arguably part of long-term horizon risk assessment, risk management, or opportunities assessments. You can mandate having specific targets. Targets are associated with performance measures, and you're seeing a lot of regulations and standards focusing on scoping the targets. In other words, if you're going to have long-term commitments, you must have specific targets and plans to get there. You must have interim targets on how you're going to get there. You must be granular and specific and deliberate in articulating how you're going to deliver on future performance. Targets is a way to explain and quantify intended future performance and goals, it's change of outcomes. When we start to talk about impact, particularly on, the environment and society, we need to have targets because we need to be able to express and articulate the change in outcome that we are desiring. All of this is definitely on the table. It's on the radar. Is it easy to do? No. Is it what you start with? No. It's very difficult for a company, and they're being asked. There are people and organizations out there that are telling companies, you need to have targets on these issues. You need to have target on climate. Well, first you need to assess whether climate is actually a material issue for you, or to what extent, rather, let me rephrase that. To what extent climate is an issue for you? How is it likely to impact you? Are you a big emitter or not? Is your supply chain a big source of emissions or not? Or are you subject to the physical risks of climate? The key message there is needing to do the work to identify whether these are material issues, and then how you're planning to address them. But it requires quite a bit of maturity in thinking and assessing and managing, and more than a few rounds and cycles of management and reporting, in my opinion, before you actually can get to viable, credible targets and actually managing to those targets. I mean, there are companies out there that put targets, but are they actually managing to those targets? Do they actually know how they're going to get there? In some cases, no. And that's the kind of thing you want to avoid happening, right? You want to be able to, whatever it is you're going to do, whatever it is you're going to put in your report, do it for real. Report on what you're actually doing. Be credible, be transparent, be authentic, be balanced, and make it part of the continuous improvement process. I'm going a million different directions here, but I'll stop here.
No, that's great. Jennifer, I want to bring you in on a question. So some of that, I'm not sure if PMI submits into the CDP. I suspect it probably does. So the CDP, like a couple of others, is a climate-related reporting framework, but it scores companies. And it depending on the quality and the completeness of your submission, you can get it an A score, etc. And these are used ostensibly by the investor community as a first insight into the ability of that particular company to be addressing climate change. Now, does this kind of scoring attached to ESG responses, is it useful? Is it appropriate?
Thank you. And yes. So PMI does submit to CDP. We're actually proud holders of AAA, one of the very few handful companies that provide and submit their disclosures to CDP analysis and that actually get their A on forest, climate, and water. We have done that for 3 consecutive years. And I think that what CDP is evaluating is, as you said before, environmental disclosure transparency. And also progress, because what I believe is that, and to your question about the usefulness, is when you're able to measure with that degree of rigor, you build an awareness about the impacts that you have that allows you to build more sophisticated strategies, or let me say it differently. I would be very surprised that a company who has a very sophisticated approach to decarbonization, meaning, like MJ was saying before, a set of aspirations, a concrete strategy, and a concrete explanation of how is it that they're going to get to those goals or targets, where in the case of decarbonization, where is it that emissions are coming from? How is it that fossil fuel consumption is going to be reduced? How is it that you can switch to renewables? What percentage is unavoidable and needs to be offset, etc. When you have that degree of granular awareness of what will it take to get there, then naturally you're able to measure better and report better and disclose better. And so there is a certain correlation between, because CDP obviously is a very robust requirement in terms of the amount of data that they're assessing and asking companies to disclose. When a company has the ability to give the degree of granularity, certainly there will be a correlation with the sophistication and the expertise that is held within the company to be able to tackle these issues. So for me personally, obviously, I would say for smaller companies, perhaps this is a luxury that they can't afford. It's a very time-consuming exercise for sure, but I do think that there's a learning curve there, and it's a good moment for a team to reflect and understand, well, where is it that we have gaps, or where is it that we don't have certainty, and why is it that we have those gaps and uncertainties? Because I should also say there's sometimes that there are certain issues, not with CDP, but other rating agencies, where some questions are asked, where we will objectively disagree. And in disagreeing, we will fail to respond because it's not material, because it's not aligned with our strategy, because the metric is not appropriately measuring what we want to measure. And we will be penalized for not disclosing or not having that piece of information, but by the same token, is not data that is relevant to our strategy, and therefore in the spirit of being strategic and transparent with what we put out there, the quality of our data, we many times don't do it.
Okay, Michael, what's your viewpoints on this? The ranking or rating of companies and their ESG responses, and I'm thinking here particularly of a company that might just be embarking on its journey and in the early stages, but can't meet the full requirements of a rating or ranking system and might be viewed as penalized.
A few things. So first of all, I'm biased because, of course, we do produce this report where every year we analyze the sustainability data transparency of every single JSE listed company, and then we rank them based on their data transparency and call them out when some of the data is horrendous. Like last year, we had one company with an income disparity ratio of over 500 to 1. It was 595.9 to 1 to be exact, which meant that the average executive director had earned by 2 p.m. on the 1st of January what it would take the average employee the entire year to earn. And so we believe that absolutely the data and benchmarking is extremely important for companies because it helps open their eyes to specific problems. You know, we had a client that 3 years ago, they had a lost time injury frequency rate of 3.80, which was, you know, over, was it 17 times Toyota's supply chain average? And we're a supplier into Toyota and therefore at risk of losing contracts with Toyota because of their high injury frequency rate. Because of the data, because of focusing on that, as of December 2022, that company has a lost time injury frequency rate of 0.00 with an investment of 50 million Rand, which is a substantial amount of money, but not substantial in the context of the risk of losing people. On a CDP specific basis, in our review of reports, what we're finding is that fewer and fewer South African companies are actually reporting to CDP standards. And it's because of the burden. And what we're finding is that fewer than 20% of the JSE listed companies are even trying to actually report to CDP. And those that do are the ones that are very large companies with a historically large sustainability team with systems that have been developed in the past that they just continue to do it because it's easy for them to continue to do, not necessarily because they're actually finding value in the CDP itself. And so most companies are pushing away from CDP and moving towards TCFD, which of course is linked and, but it's much easier for companies to actually get their heads wrapped around something like TCFD, even though TCFD doesn't give that benchmarking assessment. And so value add, absolutely for large companies with deep pockets. I'm sure there's plenty of value add in continuing to go through this process on an annual year, but for the majority of listed companies, not just in South Africa, but particularly in any emerging market, it's just cost prohibitive and time prohibitive.
Thank you for that.
Can I jump in for a bit?
Yeah.
I think it's very important for people in the space to understand the differences between a standard, a framework, a regulation, and a third-party questionnaire. Third-party questionnaire, rating, ranking, some of them don't even have questionnaires, but let's go with the ones that have questionnaires, the CDPs, the S&Ps, the UN Global Compacts of this world, that actually send out a very lengthy number of questions, 150 questions, for companies to produce responses, for them to populate, and for them to use to establish a rating, which is an assessment or an opinion on these companies that are used by investors and large companies in assessing large numbers of companies, so large portfolios or large supply chains, to more quickly assess their sustainability performance of these large numbers of companies. These questionnaires came about because, by and large, several years ago, as there was growing awareness for these issues, investors, large companies wanting to manage these issues, wanting to know what companies were doing. This comes from a need and a demand for information, and the companies weren't doing it in their reports. So this mechanism of questionnaires was created to solicit, to extract this information from companies that weren't otherwise producing this information. It served a purpose. Ratings, assessments, opinions serve a purpose. Markets need opinions. There's a lot of debate about whether investors are actually using the ratings or whether they're using the underlying information and the underlying data. I think that's evolving. Trends are evolving. Maturity is evolving also, an understanding of, you know, where the real information lies or how to use this information. I think all of that is changing. But the reality is that it was meeting a need for information on behalf of stakeholders, notably investors and large companies. Now companies are starting to produce this information in their reports. A lot of voluntary frameworks and standards were developed. The alphabet soup you were referring to at the very beginning of this webinar. Why? Because of this need for information and this market's attempt at structuring this information to make it available, comparable, reliable. These voluntary frameworks were not enough. Hence, the regulations and two big global standard-setting bodies that have set out to produce it with different approaches, hopefully complementary, but to produce, a global baseline, universal baseline of standards that all companies can use. Why? So that this information is comparable and relevant, and to produce it in such a ways with accompanying regulations in the case of Europe. Produce it in such a ways that you have to use a standard, you have to put it in your regulatory filings, it has to be externally assured, and it even has to be digitized. And again, this is to produce the availability, making it mandatory makes it available, making it standardized makes it comparable, making it audited makes it reliable, and making it digitized makes it accessible, shareable, findable by all of those wonderful machines that are reading documents today. This is complicated, and a questionnaire is not the same thing as a framework. I mean, and in the context of TCFD and CDP, these questionnaires do serve a purpose. And I think, to Jennifer's point, when you go through these questions and you're being asked to answer them, and you're going, do I do this? Do I have this information? Do I even do what is being asked of me? Those are when you can start to see the gaps and say, oh, do I need to do this? Should I be doing this? Are my peers doing this? Is this important for me to do? To the issue of materiality, sometimes you have to decide for yourself. Sometimes somebody's going to impose it and say, this is material for everybody. When we talk about the TCFD and you talk about regulations saying you must disclose on climate, this is somebody else telling you this is important for us, you must disclose on this. So defining what's material, what's important for companies to collect information on, measure, manage, and report can come from various places, from within the company, but then also from without. So I would say, doing a CDP might have actually a lot of value for somebody starting out, as long as you understand why you're doing it and you're trying to extract value in terms of, how can I get better? How can I manage this better? How can I produce more information to the market that the market is obviously asking for? CDP has completely baked in the TCFD. TCFD is also getting completely baked into the standards, to the point where TCFD is going to disappear, not because it's not relevant, but because it will have accomplished its mission. I would be curious to know how many companies find TCFD easy to implement. TCFD is actually really hard to implement, except it goes in stages, and you start where you're at. You start where you can. You do what you can. and then you move forward. It's part of that continuous improvement process that reporting actually it gets you started on. And I think Jennifer also alluded to that, is when you're doing these exercises, you're realizing, well, okay, I need to get better at this. I'm not doing this, or my data is not really, my performance data is not good. I'm not really good. I need to get better at it, right? And so it is an important driver in actually driving performance on managing those issues, which is the ultimate goal, obviously, and where arguably the real value is created.
Thank you. Thanks, MJ. I'm wanting to swing into some of the questions not coming in from the audience. There's some very good ones, but just to say my own personal experience, TCFD is not easy. It's a process, it's difficult, it's challenging. CDP and scoring, I've never been a great fan of scoring. I think it's got some fundamental problems attached to it, but it is a very good awareness raising tool. And if it translates into change and action, for, particularly from the C-suite, fantastic. If that's the objective. I just want to get in here. So there's a couple of great questions. One coming in, which I think I'm going to steer initially to Jennifer, which is, how do you get boards and executives to take this ESG information, particularly ESG risks, and turn it into business strategic thinking? When executives are thinking about a myriad other issues on their plates, business essential, typically financial, how do you translate this into financially relevant information that's going to change business decision making and business strategy?
Sure. Thank you for that question. And I think that first, it's really about how do you understand, or what do you understand by ESG? So ESG is not an outcome. ESG is an input into your strategy. Sustainability is the outcome. This is what you want to achieve with your business. And so the way that if you're running a business, irrespective of your understanding of ESG or your support to ESG or not, you're running a business where you want to have proper oversight and understanding of risks or potential risks, your ability to control them, to prevent them, or to manage them. And ESG as a form of risk is telling you there are certain issues, environmental or social issues or governance issues, that talk about policies and structure within a company, that if they are not taken care of, they can represent risks for your organization in the mid to long term, especially when you're speaking about environmental or social issues. And that's where materiality plays a role. What kind of risk can it represent? It can represent a risk to your business continuity if environmental or social issues are impacting your business. It can represent risk to your reputation if your business model is impacting the environment or the society or the local communities where it's operating. And so having that visibility and really understanding what are those environmental and social impacts gives you a degree of preparedness and awareness to run your business in a better way. And I think that as we become, as a society, more aware that the way that the world exists can no longer continue, is not sustainable. And that businesses start to understand that they are not operating only with one form of capital, financial capital, but other forms of capital, natural capital, social capital, intellectual capital, then factoring all those capitals in to understand value creation. What is it that we're depleting? How is it that we're utilizing different resources and different capitals? Allows boards, executives, and organizations to define success in a way that respects environmental and social boundaries. So this is really what ESG comes in to do. I think a company that thinks about ESG as an outcome, and just putting data out there about what you're measuring, it's not really being strategic about it. And it's not really serving ultimately the business and the bottom line.
Okay, thank you. I mean, I'd love to hear your viewpoints from within PMI and how you deal with that, but I guess that's a discussion for another time. Michael and MJ, two questions have come in, but one specifically focuses around SMMEs. So we've largely been speaking about large listed companies that might have the resources to properly capacitate a sustainability department and drive it into business practice. Their supply chain is crucially important. Supply chains that might be smaller businesses don't have that that financial ability to be tracking ESG to the extent that they should. Michael, first up with you, how should an SME actually be addressing this, and should they be addressing it?
So I give you a very specific example. Impossible Clothing started off as a 67-person t-shirt manufacturing company in Cape Town, and was roped in by the GRI to participate in a supply chain reporting project for Puma Global. And to cut a long story short, this very small company was able to demonstrate that they had a commitment to sustainability overall, human capital particularly, but environmental or natural capital in particular. They became the first carbon neutral supplier in Puma's global supply chain. As a direct result of that, Puma set up an agreement with them, which was called the WorldCat Strategic Supplier, which guaranteed Impossible 5 years of production at 100% full capacity. At the time, Impossible had grown in the 3 years between the first sustainability report and to that point of becoming a WorldCat Strategic Supplier. They'd become almost 400 employees. And the out clause was that either party had to give at least 2 years notice. So in an industry that was absolutely crumbling in South Africa, where competition from particularly Southeast Asia was so heavy, you literally could import garments fully manufactured from Madagascar for cheaper than you could actually make them in South Africa. But in that really competitive global environment, this company was able to guarantee their employees a minimum of 2 years full pay, full employment as a result of their commitment to sustainability. And again, not just the fact that it became carbon neutral, but also that they were focusing on things like absenteeism and employee turnover, et cetera. And so SMMEs, absolutely. What's interesting is it's easier for SMMEs to embed these systems than it is for the larger companies, and it's far less expensive because systems, remember, a set of Excel spreadsheets is systems, and companies can easily pull the data together. They almost always have the data, and then they report on their performance in terms of the information that is critically important to the customers. It's interesting. I just saw Nick Rocky popping up, because Nick Rocky from Trilog will also be able to talk on this subject as well with a lot of the SMMEs that they work with. But SMMEs, I'm literally just about to go off to Ghana to write a sustainability report for a garment manufacturing company in Ghana. SMMEs, and particularly SMEs in emerging markets, and I noted that someone raised the question about emerging markets. It's vital to overcome a lot of the assumed assumptions about the effectiveness of SMMEs by being very transparent, open and transparent about performance. It doesn't require a hefty, glossy report. It requires reporting, which is the verb rather than the noun. It requires disclosure that is useful to multiple stakeholders, but particularly global supply chain clients like a Puma, an Adidas, a Nike, Walmart, Disney, Gap, whoever, so that they can make sure that their sustainability issues are managed. I'm like, starting at PwC in 1999, the first sustainability assurance engagement for PwC was when we were doing a Canadian oil company operating in Sudan, Talisman Energy, and it was all based around human rights. At the time, I was also doing contractor compliance for Nike, Walmart, Disney, and the Gap, for African producers of goods that were being sold by those 4 big retailers.
MJ, yeah, please come in, and then I've got a question that might or might not be answered.
Sure.
By your response here.
Just to top up on that, I agree. I think small and medium sized companies are very much in scope here. I think that if you start from the premise that managing your material issues is good for your business, it's good risk management, it's good opportunity management, it's good financial management. And then if you start from the premise also that we have a responsibility as companies to manage our interactions with our ecosystem, in other words, the natural and social ecosystem that allows us to operate in or allows the company to operate in, we have that responsibility. And then I think this is valid for any business of any size. There's no such thing as, oh, start your company, get bigger, get profitable, and then worry about your ESG issues or your social and environmental impact. It should be baked into the business model, in fact. And there's a lot of conversations about, should ESG and sustainability be integrated into venture cap? Yes, absolutely. If your business model is not viable, unless you are creating negative impacts for the environment and society, it should not be allowed to be created and to exist in a very radical nutshell. And I would say if it's material and it's good for your business, it's good for you as a company, you should have the resources to invest in those activities in proportion with the size of the company. And it doesn't have to be complicated. And
also perhaps arguably it's a competitive advantage.
At the beginning, in some cases, in other cases not. And when you talk about, meeting regulations and regulatory requirements and compliance with, regulations that are going to get stricter and stricter, sometimes it's no longer an issue of competitive advantage, but that doesn't mean it's not important for you to do it anyway.
Okay. We're kind of heading towards time here, but a couple of questions have come up. Number one, the issue of Sustainalytics ranking organizations, whether it's Morningstar and others, that give an ESG score ranking overall to a company, and this is used by investors either in passive or active investing as well. A lot of that information is gleaned from publicly available information such as sustainability reports, etc. Very quickly, going around the three of you, pros and cons of these kinds of ranking systems.
I'll jump
Jennifer,
in.
let me start.
Yeah, sorry,
okay, MJ, you go first. Thank you. Brilliant.
The pros is that they are an assessment, an opinion, and the market needs opinions. The market is made of opinions. The cons is that they are opinions and therefore subjective, based on a methodology. It's worth what it's worth. It's not the be all and end all. It's not the absolute truth. It's not an objective assessment of performance. And sometimes, depending on their processes, not necessarily looking at or assessing things that are relevant to a company.
Okay, Michael, and through to you. Are you there, Michael? Okay, Jennifer, I'm going to come in with you.
Sorry. What were you asking? Yeah. I didn't catch your question though. Sorry.
No, the question is the value, either or, of sustainability ranking systems such as Sustainalytics, Moody's, Morningstar, etc.
Yeah. A lot of them are very, very good because, for companies that invest quite heavily in their sustainability, it's very useful to get the information to be able to conduct internal year-on-year benchmarks of performance and identify what gaps ought to be closed. And I think, as Jennifer mentioned earlier, it may not necessarily be something that's relevant to you. It's maybe not part of your materiality landscape, but it's still useful to see, how you're being measured, and in comparison to your peers, although, the peer assessments aren't always as effective as one would hope. But they're very useful for helping to guide companies. Big global companies like Anglo American and Glencore and Sasol and the likes, they've all used these things to help develop their internal systems for reporting and making sure that, they're not just ticking all the right boxes, but they're actually checking what the questions are, seeing if they're relevant within the organization, and then determining whether they ought to tick the box in the future. So they're often very, very useful. They for smaller companies, not so helpful. For emerging market companies, not so helpful. But for the larger companies, absolutely. It's just unfortunate that there are millions of companies in the world and only a very small proportion of those companies actually get evaluated.
Okay. Jennifer, I'm going to come to you because I'm suspecting you might have had the frustration of receiving different scores from different rating agencies on ESG. This is not uncommon. Can you tell us some experience from a PMI perspective and how you actually value these rating scores as a whole?
Thank you, Alex, and I agree with MJ. I think these are opinions, and I think that as we become more sophisticated in our way of reporting and in our way of assessing impact and becoming more transparent, these ratings become a little bit more, the model becomes a little bit obsolete if you go back to where the origin of these ESG ratings, where there was not so much transparency, where companies were maybe hiding a lot of the impacts that their operations were creating around the world. These ESG ratings were coming in to expose that and highlight that what you sell, what you offer is as relevant as how you make it. Now, I think now that there is my biggest issue with ESG ratings is that it is essentially a backward-looking exercise that fails to actually capture what companies are doing in terms of creating change and impact. There's a missed opportunity. I also think that methodologies are often, or most of the time, unfortunately, very, very opaque. And in being very opaque, materiality and calibration of priorities is also lost. And so it becomes so subjective that it risks becoming misleading, you see, attributing more value or more weight to issues that are perhaps not as relevant can have the unfortunate effect of hinting to companies that they need to put focus and allocate resources in areas that A, are not relevant to their business strategy, and B, where they don't have an impact, just because the ESG rating is saying so. And so I think also, and that's my last point, there's an element of ESG ratings that is based on controversies, on that emotional or a perception-based component. And again, the way that it's calibrated, the way that it's weighted, sometimes it weighs too heavy in terms of it fails to be an objective tool. And I think that what we're trying to do here, and MJ was referring to it before, in creating standards and frameworks that can harmonize the way and standardize the way in which we report and communicate. When you have ratings that are assessing in such a subjective way, it actually muddles the water a little bit. If you look at our report at the very end, we have this chart of all the ESG ratings that are, and some are thinking we're doing great, and some are thinking we're doing so-so, and some are thinking we're not doing great at all, and it's the same company and it's the same performance. And so what message does it really send, you know? I think my hopes are that from the company side, companies need to become better at communicating what is really material, becoming more transparent in how they report the data and the quality of the data. But on the other side, on the investor side, the financial community needs to become more savvy in understanding materiality, so that engagements become fruitful, productive, and actually conducive to what we're really trying to achieve here, a more sustainable economy, which I'm unfortunately think ESG ratings.
Just real quick, if anybody's interested, since you raised the issue of ratings, last week the UK government put out a proposal on regulating ESG ratings, and they were very specific that the intention is to regulate the raters because precisely they are providing an assessment which is subjective and, you know, the source of greatest controversy and discord, as opposed to, they make a very clear distinction between ratings and data. It makes for a very, very interesting read, and you know, also a very interesting read on the whole premise of why come up with regulations. And by the way, they're not the only ones. European securities regulators, Indian securities regulators are also looking into regulating ESG ratings.
And while subjective, these ratings actually are incredibly impactful in many ways in terms of guiding investor decision making, etc. So they must not be undervalued. So unfortunately, you have to bring this webinar to a close. It's been a most lively webinar, a fantastic webinar. I'm just having a quick scan of the responses from some of the attendees. I mean, it's all around. It's a tremendously huge thanks to MJ, to Michael, to Jennifer for some very enlightening conversation, some very stimulating conversation. There's one great response here saying that we need to review and relook this at this particular webinar for the value that it brought. So I thank all three of you tremendously for your input, for your time, and most importantly for your thoughts based on the huge depth of experience that all three of you have. So thank you very much. We will capture all of these comments. We will share them with you, and hopefully maybe there are even some questions that you can answer directly back. But I'm going to hand over to Carolyn, and really with a very deep, sincere thanks to all three of you and to the audience for all those wonderful questions that have come in. Many thanks.
Thank you very much, Alex. Thanks very much to the panelists, and especially a big thanks to Novisto for sponsoring this webinar. It wouldn't have been possible without Novisto to host this webinar today and make it publicly available to everyone online. And more than that, this video is available for access through the web page, and that's the live stream video that we have available on YouTube as well. So a very big thanks to Novisto and to MJ for arranging for that, and a big thanks to Alex for hosting this event. And please watch out for our next ESG Exchange First Tuesdays event, which will be on the first Tuesday of May. So looking forward to that. Again, Alex will be hosting, the speakers will be announced, and we'll keep you posted through the newsletter. I did say in the chat that MJ actually authors a very interesting newsletter that you can access through the Novisto webpage, and I urge everyone online to please go and have a look at that. I did put the website address on the chat function. Thanks everyone, and thanks very much again to the panelists and to Alex for today's webinar. Thank you.